I'm going to talk today about COVID-19, small businesses, and the Paycheck Protection Program. This work is joined with Tetyana Balyuk at Emory and Prabhala at Johns Hopkins. So COVID-19 has been a black swan event. It's affected the economy enormously, but it's had a particularly large impact on small businesses. So small businesses, defined as businesses with less than 500 employees, as per census data, account for 99% of all US businesses. And they were particularly hard hit. So given their importance, there was a big policy response in the form of a 669 billion Paycheck Protection Program, or PPP. So PPP essentially gave loans up to 10 million for businesses with less than 500 employees. And there was forgiveness so long as you used it for eligible purposes such as payroll and rent. And for other things, it was priced at 1%, which is still very cheap. So it would appear that PPP loans are a great deal for businesses, but are they? So we investigate PPP piped to 678 small public firms. And we ask which kind of companies take PPP and what is the treatment effect? And what we find is firms taking PPP see positive valuations increasing in the order of 1.6 billion, which is large. Yet, despite this large valuation increase, we find many firms actually return the PPP funding without using it. And when they do, they see large valuation increases, actually in the order of 1.8 billion, which is again very large. And so why do we see this? We'll actually speak to some of the reasons behind this. And then we look at is the way that you get PPP, the way it's funneled through banks or intermediaries, does that affect the distribution in any way? And what we find is that large firms get PPP earlier, and this is particularly true if you're a large firm in a big bank. And so, again, we'll speak more to that in terms of why do you see this sort of distribution. So PPP is clearly massive, and it's important to understand in its own right. But another reason to study PPP is in the broader context, it gives us other lessons that we can learn. We can think of PPP as a shock in financing supply. Simultaneously, it's also a shock in loan demand. So understanding it helps us understand how to deal with small businesses in times of crisis. So we have collect data on 678 public firms who are borrowers of PPP. And the research questions we ask is, what is the uptake of PPP? What is the stock market valuation? And we find we have very positive stock market valuation. And despite that, there is a reluctance to take PPP. More than 100 firms, 100 high quality firms, return PPP funding without actually using it. And when they do, we see again increases in the share price. And then finally, we ask, how does the channel or the banks who deliver PPP funding shape the supply of financing and why? And so for small businesses, PPP is a shock in financing supply, right? And so when these businesses take PPP, we see positive abnormal returns. So we see big shareholder gains. Now, these are partially anticipated because you have the announcement that there's going to be a PPP program, and then later on, individual firms announce that they're going to take it. So once you correct the treatment effects for partial anticipation, we find the gains for the sample are in the order of 1.6 billion, which is clearly large. Now, despite these large gains, we find firms seem to be wary of taking PPP. More than 100 firms return it. And when they do, the gains to this sample is in the order of 1.8 billion, clearly very large. And again, these tend to be better quality firms that return PPP. And so the natural question is why? PPP is cheap. It's either free money or it's bounded at 1%. Why would you not take PPP? And it would appear that firms, particularly the stronger ones, they actually think PPP is costly, not because of direct costs, but they are high indirect costs. So what are these high indirect costs? Most likely, it is the possibility that you'll be investigated ex post, right? You'll be audited. And so public firms were often singled out that if you're public, you have access to capital, perhaps you shouldn't be taking PPP funding. You should let others take it. And so there could be fear of penalties, there could be fear of reputational damage, etc., that made PPP recipients wary of should we keep the funds or should we return them. So to investigate this further, we look at the following experiment. There were pronouncements from the SBA as well as the Treasury that if you took PPP funding for less than 2 million, then it was assumed that this was in good faith. But so the probability of audit increased after the 2 million threshold. So we can look at, 2 million as sort of being a cutoff and look at loans just below that and just above that. And when you do that, you find the probability that the loans are returned, if you're just above the threshold, is 21%, as opposed to 7% if you're just below the threshold, right? And so this is very consistent with firms worrying about this ex post investigation or regulatory scrutiny that they might have to bear. Now, if you think of the demand shock, right? So for intermediaries or for banks delivering PPP, it's a shock in demand. And in fact, banks were flooded with PPP applicants. 525 billion were dispersed to more than 5.2 million firms. And in fact, the first round of PPP funding was exhausted. A second round had to be approved. And so we look at, do certain kinds of firms get PPP early? And the answer is yes, large firms tend to get PPP early. So if you look at the distribution in round 1 and round 2, you can see in round 2, there are many more small firms going for PPP as opposed to round 1. Now, why is this the case? To understand this, we look at the way PPP is given, and that is through banks. And we ask, do we see differences by certain kinds of banks? So in particular, we look at the largest banks or the big 10 banks, and we look at the other smaller banks. And we see a big difference in them. So here, the red line is early PPP borrowers. The blue line is late PPP borrowers. And you can see that large firms go early, but this trend is more pronounced in the large banks as opposed to in the smaller banks. And this is true not just for firm asset size, but also for PPP loan size. Again, you see very similar results. So again, the question is why, right? And so you're seeing large firms go early, especially with big banks. So this is pointing to some frictions. So what could the possible frictions be? So one might be the PPP fee incentives. So in general, you got larger fees for larger loans. But that doesn't explain why you would see this differential between large banks and small banks, right? And so one reason you might see big banks prioritizing larger customers is you have capacity constraints. You want to prioritize those customers that are most profitable for you. And large firms have multiple needs. They need more funding. It's one-stop shopping, multiple services. And so in the face of capacity constraints, big banks might choose to prioritize large customers. Now, small banks, on the other hand, they tend to treat small borrowers well. They're their bread and butter, and they deal with them on a daily basis. And so our findings suggest that pairing small borrowers with small banks, might make sense. Now, traditionally, this is thought to be good because small banks are better at processing soft information, at scrutinizing and doing the screening or monitoring for small firms. What our results suggest is that over and beyond soft information, there are other frictions that when capacity constraints mind, that there are perhaps negative externalities of being a small firm with a large bank. It's like being a small fish in a big pond. You just don't get the same priority or importance. So understanding these frictions of big bank lending to small firms is certainly worthy of further research. Now, a sample again is of listed firms who actually file periodic disclosure requirements. And so demand side explanations really seem less plausible. This looks like supply side frictions that are taking place. So, what do we find in summary? We find when firms take PPP funding, there are positive valuation gains. Yet, despite that, many firms actually return these PPP funds. And when they do, they again experience large gains, right? And this points to some concern of large indirect costs of government aid, from whether it's from regulatory scrutiny or ex post sort of investigation. We also find that the channel matters, right? That large firms tend to get PPP funding early. And this is especially true if you're a large firm with a big bank, right? And so banks were the channel through which PPP was done. And what we seem to be finding is that the banks have their own incentives, which results in large firms benefiting. And this is particularly true again when they're with big banks. And so to conclude, we've looked at PPP as a large sales shock in financing supply and loan demand. So what have we learned? So first, if we're trying to design fiscal subsidy programs for corporations, clearly it's important to have very clear ex ante eligibility criteria. But it is equally important to have very clear ex post audit processes after the uptake. So if there's uncertainty, if there's ambiguity, then this tends to discourage firms from taking on the subsidies. So delineating safe harbors may be useful in encouraging uptake. We also find the channels matter. There are frictions in intermediaries that can change or heavily influence the delivery of financing. They can shape who gets funding and how soon. And as we see, it's large firms who get funding soon, and particularly if you're a large firm with a large bank. Thank you.